Welcome, everyone. Happy to have you in this session for a mini conference, our first online version of this. So I'm glad to have you in this session. I'm Susan Henson, and for those that don't know me, I'm the Regional Director for Mason Enterprise Center programs here in Loudoun County. That includes both our SBDC program, that of course you're familiar with if you're logged on, that provides advising and classes and mentoring for small businesses. And then I also manage a business incubator program here in Loudoun County. We're based in downtown Leesburg and have a facility there with small office spaces, specialized mentoring and connections for companies that are ready to grow their business. So if you're interested in any of that, you can follow up and we'd be happy to plug you into any of those resources. But here this morning, I wanted to welcome you to our session, and I'm going to introduce to you Rod Johnson. Rod is a native Washingtonian. He has a BS degree in business administration and a master's degree in financial management. He has spent 30 years in commercial banking, rising from a young commercial banking trainee to a senior vice president of commercial banking, working for 3 of the top 5 banks in the United States. In 2008, he started his own business, RLJ Financial Consultants, LLC, which provides commercial loan brokering and business insurance across the United States. As part of his dedication to serving his community, Johnson has served on numerous boards of directors for nonprofit organizations throughout the years, and he's currently on the board for New Endeavors by Women. Rod's position now with the SBA is the Lending Relations Small Business Development Center Project Officer, and he's based out of the Washington, D.C. District Office. So I want to give a warm welcome to Rod, and Rod's going to walk us through a number of programs that I think you will find very advantageous for your small business. Rod, I'll turn it back over to you.
All right, well, thank you very much, Susan. Let's go to the next slide, please. Good morning, everyone.
Can I just say one other thing, Rod? If you have questions, I wanted to point out, please put your questions in the chat box, and we will be taking those questions at the end. So don't miss getting your question down when you think about it, and we won't overlook those. So meant to give that one little point.
Yes, please do, and thank you, Susan. I am so glad to be here this morning, and we're going to talk about something a little different than what we've been hearing about in the news. I would say probably in the last 90 days, right? So what have we been hearing in the news? We've been hearing about the Paycheck Protection Program, all right? We've been hearing about the forgiveness and then the extension date to May 31st, okay? Then we've heard about the EIDL program. And with the EIDL program, all right, so that's been extended until December 31st this year. The maximum has been raised from $150,000 up to $500,000. Also with the EIDL, there's been the EIDL grant, okay? And the EIDL grant has been replenished to $20 billion. Now, the only difference with this EIDL grant is that your business has to be located in a moderate to low income area, and the SBA will contact you. All right, then the next program that took a long time to get launched was the Shuttered Venue Operators Grant, okay? And so that opened up for us last week, and it's actually the SBA, the Office of Disaster Assistance, is the one that's actually administering that program. And then today at 12 noon, the last program, the Restaurant Rescue Fund. That's opening. The portals at the SBA are opening today at 12 noon. Now, we all know about the other 3. So I'm going to give you this address, restaurants.sba.gov, okay? That's where you're going to go for the Restaurant Rescue Fund, all right? And then, you open it up and it's going to be like a 5-page application. And then it will tell you all the information you need to apply for that fund. Okay, so those are the resources to help you sustain your business. But this morning, we're going to talk about growing your business because you still Even in a pandemic, go to the next slide, please. Even in a pandemic, you can grow your business using SBA program, okay, financing programs. And so I think this is an exciting time actually to get an SBA loan, because the SBA now has incentivized the banks to actually make you loans. And then the best part is you don't have to pay for the SBA for those loans, okay? Because there's usually a fee associated with it. So we're going to talk about the benefits of the SBA, the 7A lending parameters, other SBA loan programs, and I'm going to tell you I'm biased toward one of the programs because I love it. All right, then there's determining eligibility, credit considerations. There's always credit considerations, right? The use of proceeds, and then the lender resources. So let's go to the next slide, please. So what are the benefits of the SBA? So let's go to the next slide. All right, so the SBA benefits the lender this way. So the SBA, we provide a guarantee against a loss for the bank. We'll keep our fingers crossed, right? Hopefully. All right, so it lowers the risk, it increases their profitability, improve liquidity, and it helps the banks grow their portfolio. Why? Because they're lending money to you, the business owner, at a reduced risk. All right, the lender's guaranteed, not the borrower. And I'll pause here for a minute. So if for some reason your business does not make it, it goes under, then the bank comes to the SBA. We will give them the guaranteed portion of the loan, but at the end of the day, it's you and I, the taxpayer, that actually pays for that default. Okay, so just understand that. All right, next slide, please. All right, the benefits to you guys. You get a loan approval. And actually, as we go through the programs, you're going to see that it's going to be pretty easy to get an approval these days. All right, lower down payment, offers longer terms, eliminates balloon payments, and it covers collateral shortfall. So for you guys that are out there thinking about doing an M&A deal, then if you use the SBA 7A program, which is the most popular program to use to do an M&A deal, actually, if the business has strong cash flow, the bank will tolerate a small collateral shortfall. Okay, but we'll get into that later. Next slide, please. Okay, so what are the two typical uses of the SBA guarantee? Typically, there's insufficient collateral. Startups. Now, you know, startups are usually a bad word, and particularly the restaurant industry. When you mention startup and restaurant, oh my gosh, bankers typically don't want to hear that. However, with the SBA, actually, we'll take a look at the startup or that restaurant. That's a startup, okay? So that's a good use of the SBA program. Industry risk. There may be like the construction industry, the restaurant industry, and some other industries that pose an undue risk in a lender's eyes. Well, if you use the SBA guarantee program, it mitigates that risk. All right, poor historical earnings. So one year you may have a 50,000 net profit, then it may go up to 100, and it drops down to 25, then it's 10,000. All right, so the SBA risk helps, the SBA guarantee helps mitigate some of the poor historical earnings. All right, and then you started the business, but it was underfunded. You didn't start it with a lot of capital. So the SBA guarantee actually helps the bank overcome that equity insufficiency. All right, next slide, please. All right, so now we're getting into the SBA's, next slide, please, signature program, which is the 7A program. All right, so the maximum loan amount is $5 million. I think that takes care of a lot of the loan size that most businesses need. The maximum guaranteed amount is $3,750,000, okay? And that's with a 75% guarantee. As you see here, over $125,000, the bank gets a 75% guarantee. If it's $125,000 or less, the bank gets an 85% guarantee. However, because of the pandemic, the bank gets a 90% guarantee, period. A 90% guarantee for an SBA deal, 7A deal, okay? That gives the banks incentive to want to lend to you because of that 90% guarantee, all right? And it makes a difference. The other thing is the bank doesn't have to pay the annual SBA fee for doing that loan for you. That gives the bank increased incentive to want to lend to you. So not only do they not have to pay an SBA guarantee fee, the annual fee, but now the loan that they make to you, they receive a 90% guarantee from the SBA. I mean, I think that's fantastic. Okay. All right. Next slide, please. All right. So here are the uses of the proceeds. So for working capital, right? Current assets minus current liabilities, working capital. All right. You can get up to a 10-year maturity. Typically, that takes the form of a term loan. You can use the 7A for a line of credit. Okay. And as you know, a line of credit is typically 12 or 13 months. And then it can be termed out for 5 years or for 10 years, depending on what the bank wants to do. All right. You can also purchase a building using the 7A program. I know a lot of you have heard about the 504 program, but remember I mentioned earlier about my bias. I'm biased to the 7A program. All right. So you can get up to 25 years plus time to complete the construction and renovation. So therefore, you have a piece of land. You can use the 7A to buy the land and do the construction, okay? And you have up to 25 years. The great thing about this is that you don't have a maturity like you do when you go for conventional finance. So for example, let's use the same example. You can purchase the land, now you want to construct a building on it. But what the bank may do is say, okay, you have, we'll say 9 months construction period. After the construction, we'll give you a 25-year amortization, but you have a 5-year balloon, okay? And that's typically how it's underwritten, or you even may have a 10-year balloon, which means that the loan becomes due in full in 5 or 10 years. Under the 7A program, you don't have to worry about the balloon, okay, at all. It's a straight 25 years. Also, the prepayment penalty goes away after 3 years. In conventional financing, you may have that prepayment penalty if it goes up to 10 years. You could have a prepayment penalty for up to 10 years. With this program, it goes away after 3 years, okay? Furniture and fixtures, generally 10 years, maximum of 25, not to exceed the life of the asset, okay? This is great. And then refinancing based on the use of the proceeds, the loan being refinanced, you can actually refinance into a 7A program, okay? So it's good for refinancing. Next slide, please. All right, maturity on mixed loans. So here you have a weighted average. Here's an example. So you could have a real estate loan. The amount is $300,000, machinery and equipment, $100,000, working capital, $100,000, totaling $500,000, okay? And so here you have, in this example, 25 years, and we'll consider the ability to repay. And then you use the maximum turn of the asset class, that's the largest percentage of the use of the proceeds. So here's a way that you can use the program to buy real estate, to buy equipment, and have working capital, okay, using the 7A program. Go ahead, next slide, please. So you have a base rate. So as you can see, based on the loan amount, okay, and typically I like to use this program for real estate, okay, I'm biased to that too. So I like to use this program for real estate because unlike the 504 program, which we'll talk about a little later, you'll have two loans. You'll have the loan to the CDC and the loan to the bank. With the 7A program, you only have one loan, and that's just the loan to the bank. So for the real estate, you'll put down 10% and the bank finances the other 90%. With the 504 program, you, the borrower, you put down 10%. The CDC, Community Development Corporation, takes 40%, and the bank takes 50%. So that's why you're making two loan payments. With the 7A, you're just making a loan payment to the bank. Now let's get back to the rates. All right, so if it's less than 7 years and up to $25,000, it's 4.2, it's the base rate, which we're using prime, right? So prime is 3.25, and so it could be up to 4.25%. Let's jump down to 50,000, because most of the loans actually in the 7A program are generally over 50,000. So now the term is 3.25 under 7 years plus 2.25. So now you actually have a reasonable rate, okay? If it's over 7 years, it can be 3.25 plus 2.75. And again, I'm using the Wall Street Journal Prime. Typically the banks, and I think now I need to change the slide, the banks have gotten away from using LIBOR, the 1 month LIBOR. So generally it's the Wall Street Journal Prime rate that we're using to fix these rates. And the rates can be a fixed rate or a variable rate, just so you know, okay? Next slide, please. All right, so the fees, remember I talked about guarantee fees, the fee charged on guaranteed portion of the loan may be passed on to the borrower. Well, now you don't have to worry about that. You don't have to worry about paying any guaranteed fees. The lender doesn't have to pay any fees to the SBA. But if we still had that in effect, you can see here, depending on the loan amount, what the guarantee fee rate would be. So if it's over $700,000, which most real estate loans are, then the guarantee fee would be 3.5% on that $700,000. Okay, just to use as an example. So just keep in mind, none of these fees apply because of COVID-19. So there are no fees that you pay, and the bank doesn't pay any fees to the SBA. Next slide, please. All right. So for loans in rural areas or hub zones, right, there is fee relief. And for the SBA Express, let me say this, the SBA Express loans and the veteran-owned loans, they were capped at $350,000. Now, because of COVID-19, those loans go up to $1 million. $1 million, okay? Instead of the bank getting a 50% guarantee to do that SBA Express or veteran loan, now they get a 75% guarantee, okay? So if they made $1 million line of credit to your business, $750,000 of that $1 million loan is covered by the SBA. So the bank's only risk is $250,000, okay? Now, you say, well, what's the difference between the SBA Express and the 7A? Well, again, the SBA Express only goes up to $1 million, and it is a 7A product, but the regular 7A loan goes up to $5 million, and now it gets a 90% guarantee. Also with the SBA Express, the bank gets to use their own loan documents. So therefore, typically the bank can actually process the SBA Express loans a lot faster than under the regular 7A signature program. Also under the 7A signature program, if the bank is not a preferred lender, then the bank has to approve the loan, and then the bank has to send that approved loan to an SBA processing center to be approved, okay? But if the bank is an SBA Express preferred lender, then the bank actually will just put the loan into the E-Trans system. And typically about 24 hours later, the SBA will give an authorization code to the bank, okay? So when you're looking to do a 7A real estate deal, you want to go to a preferred lender, all right? Next slide. Other fees. You don't have to worry about the ongoing fee. The bank doesn't have to worry, the bank doesn't have to charge an additional fee, okay? And so for now, because of the pandemic, you don't have to worry about an ongoing fee. Neither does the bank. Next slide, please. What I want you to walk away with is there's no fee, okay, that you have to pay or the bank has to pay. Now, there is, if you have someone package up the loan for you, then there will be like a packaging fee, and a form 159 has to be filled out, which your lender will actually do that or help you with, but there'll be more clarification on this later. All right, next slide, please. I think typically the packaging fee is about $1,500 at the most that can be charged, okay? Prepayment penalties only applies to loans with 15 or years greater maturities, but typically it's 3, 2, 1, right? Meaning 3% the first year of the loan, 2% the second year of the loan, 1% in the third year of the loan, and then that's it, okay? So it just depends on how it's structured. It's usually 3, 2, and 1, okay? All right, next slide, please. Other SBA programs. Okay, what are we talking about? Next slide. All right, so we've actually talked about the 7A Express. We talked about actually the SBA Veterans Advantage, which is really just like the SBA Express, except that, the loans are made to veterans. Then you have the cap lines. Typically, construction contractors and government contractors use the cap lines, as well as retail establishments for working capital and seasonal lines. And then you have the Community Advantage, which typically goes up to $250,000, which is usually an organization like the Latino Economic Development Corp or the Washington Area Community Investment Corporation. They use the Community Advantage loans because they do business in low and moderate income areas. Then you have the SBA 504 program, which I described earlier, which you put in 10% of the deal. The CDC takes 40%, the bank takes 50%. Typically it's used for real estate and equipment and the acquisition of land. And then you have the microloans that are up to $50,000. So let's go to the next slide, please. All right, so here, normally, the SBA Express, as I mentioned earlier, goes up to $350,000. And actually in September, well, actually it's October 1st of this year, the new maximum will be $500,000. Okay, the new maximum will be 500, not 350. The guarantee will be reduced to 50,000 from 75,000. But for right now, as I said again, the SBA Express goes up to $1 million and gets a 75% guarantee. When we return to normal, the new normal, I should say, the SBA Express will go up to 500,000 maximum and still have a 50% guarantee. And as you can see with the interest rate, it'll be the prime rate plus 6.5%, okay? And for loans greater than 50,000, it'll be the prime rate plus 4.5%. And as I stated earlier, the lenders use their own forms and procedures to get the loans approved. And it's the same way with the SBA Veterans Advantage, all right? Same way. Next slide, please. We can go to the next slide because we've talked about it. All right, export financing. Yeah, the Export Express, the Export Working Capital Program, and International Trade Loan. All right, next slide. All right, I must have got my slides mixed up, but here we go. The community advantage. The lenders must be a CDFI, CDC, or micro lender targeting underserved markets. And as I said, the maximum loan amount is $250,000. And as I stated, the Latino Economic Development Corp or the Washington Area Community Investment Corp are the two main ones that stand out to me in this area. You get an 85% guarantee. They get an 85% guarantee for loans of $125,000 or less, and a 75% guarantee for loans greater than $125,000. All right, and as you see, again, it's for mission-focused lenders only, and this program expires in the way that it's written in March 2022. Okay, so for those loans that are basically $250,000 and below, you probably want to look at a certified development financial institution. What comes to mind there is also an industrial bank that's located in Washington, D.C., or a City First Bank that's also located in Washington, D.C. Okay. All right. Next slide, please. The 504 program, right? This is for fixed asset financing, real estate, large equipment loans. All right. The loan, just like the 7A, is up to $5 million. And the loan participation is between a bank and the SBA. Okay. And we've talked about the structure. 50% bank portion, 40% SBA, or basically a CDC, and 10% you actually put into the deal. Okay. Next slide, please. Most people use the 504 for real estate, but you can also use it for real estate and equipment. Okay. Non-7A loans, a micro loan. These are loans done through nonprofit organizations, and they provide technical assistance. The maximum, as I stated before, loan amount is like $50,000. The average is usually $20,000. You usually have, these loans are usually made to purchase machinery and equipment. That's primarily what I've seen these loans used for. I haven't seen it used that much for working capital, okay? But it cannot be used to repay existing debt. No real estate or leasehold improvements cannot be used for a microloan, okay? So it's typically machinery and equipment and working capital. But in my experience, I've really seen it used more to purchase machinery and equipment. Next slide, please. Determining eligibility, that thing called credit elsewhere. Next slide. All right, so you have to be able to demonstrate a need for the credit, okay? It has to be an operating business engaged in an eligible industry. So for you guys out there that are professional gamblers that have a Schedule C, okay, that, you know, gamble at Delaware Park, Dover Downs, MGM Grand, Horseshoe, and Maryland Live, you're not eligible for this program, okay? I have been asked that question. You are not eligible for the program, okay? It has to be organized for profit. It must be located in the United States, and it must meet the SBA size standards. All right, next slide, please. Ineligible uses. Now, unlike the PPP and some of the other COVID-19 related programs, generally nonprofits are not eligible for the program, okay? Financial businesses, life insurance companies, pyramid sales distribution plans, right? Like Amway and 5 Links and some of the others that you may know of. Government-owned entities are ineligible. Loan packagers, okay, earning more than 1/3 of their income from the SBA packages are ineligible, and speculative businesses. So you guys that like to go out and speculate in the stock market, you're ineligible, okay? All right, next slide, please. More gambling, which I already mentioned. promoting religion, providing sexual material, a prior loss to the government. Well, you know, for some of these COVID-related 19 programs, that's been relaxed because typically, if you defaulted on a student loan or a prior SBA loan or any government loan, you were ineligible, okay? Under normal circumstances, you're going to be ineligible. But because of COVID-19 programs, depending on the program, typically this has been taken off the table. Okay, passive owners of real estate, and then principals on probation or parole, okay, or convicted of a felony, of a financial felony, okay, are typically ineligible. Next slide, please. All right, the long and the short of this on marijuana is, you know, states continuing, just like I think the Commonwealth, if I recall, just passed a bill saying that marijuana was okay, if I recall. They just passed a bill on that. A lot of states seem to be passing a bill for the pot industry, as I call it. Right now, though, it is still federally illegal, but the SBA is taking a look at it, okay? That's what I'll say. And that kind of sums up this slide. All right, next slide, please. So in other words, right now, the marijuana businesses are ineligible, okay? Now, personal eligibility, right? Because you will be giving a personal guarantee for the loan. So each owner who has an interest of 20% or more interest in the business will be a guarantor. You had to be of good character. You got to be legally in the United States. You got to be able to demonstrate the need for credit with no prior loss to the federal government, okay? We had to be able to determine credit. That's with the credit reports. That's with the 912. And then we're going to ask you to fill out the 4506T form for verification of your personal tax returns. Most of you, if you've applied for SBA COVID-19 relief funds, you should be familiar with this 4506T form. All right, next slide, please. Size and affiliation. All right, so you have to have the business, has to have a tangible net worth of less than $15 million and net income less than $5 million, okay? And so these are some of these size standards, okay, by NAICS code. So let's look at construction. So you can't be over 33 million, wholesale 100 employees, manufacturing over 1,500 employees, okay? Retail and service can't be over 35.5 million. But you can go to the sba.gov/size and see if your business actually meets the size standards, okay, for your particular industry. All right, next slide, please. Passive companies. An eligible passive company holds the fixed assets of an operating company. Both the EPC and OC must be co-borrowers on the loan. So for example, you could have Susan Henson LLC for the express purpose of owning real estate. And then you could have Susan Henson, where her operating company is where she sells real estate. But she has a building on a little 3-story office building. And so that's why she set up the LLC. So they must both be co-borrowers on the loan, okay? All right, next slide, please. Credit considerations. Go ahead, next slide. Now, the lender is going to use the 5 C's of credit, right? Character, capacity, collateral, cash flow, okay? But cash flow is king because it's the primary source of the loan, not liquidation of the collateral. It's the cash flow, okay? Next slide, please. All right, so the lender, and this is giving you a feel what the lender is going to be doing when they're considering your request. They're going to look at the nature and the history of your business. They're going to look at who you are as an owner and guarantor. So they're going to do an analysis of your personal financial statement. They're going to make sure that the tax returns that you gave them as part of your package matches up against the data that they receive from the IRS. They're going to look at the financial condition of the business before and after the loan, meaning what does your balance sheet look like? Okay, what does your profit and loss statement look like once this loan is made? What's your collateral? How much collateral do you have to, frankly, collateralize the business? Do you have enough equity in the company? Okay, because what you're doing is when you're growing a company, you want to use a combination of the company's equity and debt, right, to grow the business. All right, next slide, please. All right, the debt service coverage ratio, okay? If you have a pen, here we go. I'm gonna give it to you, which is EBITDA. Net income plus depreciation, plus amortization, plus interest expense, minus any dividends or distributions, divided by current maturities of long-term debt, plus interest expense, okay? And that's on the new and existing debt. So I just gave you the definition of debt service coverage, and that must come out to be 1.25 times or greater, okay? Then they'll do a ratio analysis, depending on the industry. Current ratio, quick ratio, debt to worth, okay? They're gonna look at that. Then the working capital adequacy. Then they're gonna look at, what's the rationale for approving the loan? It's been in business for 10 years, okay? Stable earnings, good revenue growth, good debt service coverage is, 1.5 times for the last 3 years, okay? They're gonna discuss the collateral. What do we have as collateral? Accounts receivable, inventory, equipment, okay? So those are all the things that are gonna be included as part of the analysis. Are there any prior liens or judgments or bankruptcies, personally or associated with the company, okay? So all of these things go into the approval package, all right, to be approved. Next slide, please. Cash flow, all right. The acceptable, there's a credit scoring. Actually, I need to change this. The acceptable credit score is now 160 or higher, not 140. It's now 160 or higher. And the way that it's an acceptable credit score, the things that I just talked about on the previous 2 slides, okay? So that's how your credit score, when you take into account the personal information and the business information coming together, the acceptable score is now, as of last October, 160 or higher. Next slide, please. The minimum, well, they talk about the minimum debt service coverage here must be equal to 1.15. I would tell you the banks are looking for 1.25 or greater, okay? You have $1.15. What this means is you have $1.15 for every dollar of debt. Or what the banks are looking for is $1.20. You have $1.20 for every dollar of debt, okay? That's really what that means. Next slide, please. Equity requirements. Now, of course, we expect you to have decent equity. So you have to have a minimum of 10% into the total cost of the project, okay? Now, depending on an industry, if it's the restaurant industry, a bank may require 10 to 20% of equity into the deal because of the very nature of the business, okay? Restaurants are risky, so banks may want a higher percentage than 10% into the total project cost. But that 10% must be cash that you're putting into the deal. It can't be borrowed funds. It must be cash, and it must be verifiable. And it's verifiable either through the bank statements or your brokerage statements, okay? Next slide. the collateral requirements. All right, 25 up to 25,000. As some of you already know, if you've used the EIDL program, then you don't have to use collateral. If it's 25 to 350, usually the banks will follow their own collateral policy. And then 350 and above, fully secured to the extent possible. Yes, we'd like to see dollar for dollar collateral over 350, but in some instances, there's trade-offs. So if you have a debt service coverage of 1.5 times, then instead of getting dollar for dollar collateral, maybe you'll say, okay, the cash flow is strong, and as long as I have maybe 85% collateral coverage, then I feel comfortable with that. So every deal is different. Okay. All right, next slide, please. The collateral requirements. Go to the next slide. We won't worry about that. All right, with multiple loans for the same purpose with the same collateral, the lender cannot have a superior lien position to the SBA. In other words, there must be equal footing. So when it comes time to have to liquidate the loan, then both the SBA and bank have equal footing as it comes to their dibs on the collateral, okay? So the lender can't be in a superior position to the bank. All right, next slide. To the SBA, sorry. We already talked about the guarantees. Owner 20% or greater, you're guaranteed. That's just it. The banks are going to make sure that you guarantee. They talk about full or limited guarantees, but typically, if you're a 20% owner or greater, generally you're going to fully guarantee the loan. That's what most banks are going to require of you, okay? And you're going to have to provide a personal financial statement and personal tax return for the last 3 years. So we're talking about 2018, 2019, and 2020. Next slide, please. Life insurance. Typically, lenders may ask for you to, and they should, not may, the lenders will ask for you to actually assign your life insurance policy. If you don't have one, you got to go out and get a term. You can get a term loan, you can get a term policy, whole life policy, universal life policy. But typically this is done because if you get hit by a bus, the SBA wants to make sure that, they can get repaid, okay? So that's why the SBA usually asks for the assignment of a life insurance policy, okay? All right, next slide, please. Use of proceeds. We kind of talked about these already. Startups, M&As, expansion, working capital, buying a building, equipment, inventory, debt refinancing, you're exporting goods. Next slide, please. You can't pay delinquent taxes, okay? Floor planning, no, we're not doing floor planning. We're not doing investment real estate, okay? And we're not paying distributions to or refinance debt for associates of the applicant. In other words, you can't cash out, okay? All right, next slide, please. Real estate occupancy. So as you saw in the previous slide, we're not doing investment real estate. It's owner-occupied real estate, which means you must occupy, your business must occupy 51% of the rentable space, okay? And may permanently lease out 49% of the space. All right, so let's take an example of a mixed-use property. So mixed use meaning you may have an all-state business on the first floor, okay? And on the second floor, you may have 2 apartments. Well, just as long as the all-state on the first floor occupies 51% of the total rentable space, then and that's great. And then you can rent out the apartments, the 2 apartments upstairs, okay, to outside tenants. So that's typically how that works, okay? For new construction though, 60% must be occupied by the applicant permanently, 20% may be leased out permanently, and the other 20% may be leased out temporarily, okay? Now, the applicant must occupy some of the space within 3 years, and the applicant must occupy all the space within 10 years, okay? So there are your occupancy requirements, but just go to the next slide, but just remember 51% of the eligible rentable space is what you have to rent. Okay, refinancing eligibility, existing debt on unreasonable terms, right? So this is how you refinance. There's a demand note or balloon payment, the debt with an interest rate that exceeds the SBA maximums, credit card obligations used for business-related purposes, debt that's over collateralized, revolving lines of credit where the original lender is unwilling to renew. All of these fall under the refinancing eligibility. Restructuring revolving lines to obtain a lower interest rate or longer terms, or aggressive maturities. Again, these are the reasons, in fact, you should post this up on your wall. These are the reasons for you're able to refinance existing debt, okay? All right, next slide, please. Using SBA products. The original loan purpose must have been SBA eligible. Installment loans require 10% reduction, right? Same institution debt, include a 36-month transcript with explanation of late payments if there are. An SBA debt at another institution, you got to verify and document the current lender is unwilling to match proposed terms. So when you're going to look, to refinance debt, SBA debt, keep this in front of you because there are rules that you have to follow to be able to do that. All right, next slide, please. Change of ownership. All right, so the purchase must result in 100% ownership. It must be in the best interest of the business, not the buyer or seller. It has to be an arm's length transaction, which means there has to be a buy-sell agreement, a business valuation, okay? The lender prepared acceptable of less, the qualified third party valuation required of tangible assets exceed 250,000. That's what the M means in banking. It must be submitted at the time of application. All right, so for an M&A deal, what does it mean? So you got to have your buy-sell agreement. You have to have the valuation already done, okay? And these things must be submitted at the time of application. And you must submit the current business and personal financial statements of the existing business. And you must present projections day one for the new business going forward, okay? So when there's a change of ownership deal, these are the requirements. Next slide, please. We see a lot of this in government contracting. All right, the seller debt may not be considered as part of the equity injection unless it is on full standby for the life of the SBA loan. Full standby means that it's just sitting there. It's not getting any principal or interest payments on that seller debt, okay? So yeah, the seller may take back a note, but he can't get paid on it for the life of the SBA loan, okay? And it cannot be for more than half the required equity into the deal. Next slide, please. You need help? You go to your local small business development center, okay, for help, or your women's business center, or your veterans business center, or SCORE, okay? And if you have questions about 7A, of course, you can email 7aquestions@sba.gov. And of course, you can email me at roderick.johnson@sba.gov, because I know all the preferred lenders throughout the DMV. I know which banks are very good at processing 7A loans, 504, and SB Express loans. Okay, so feel free to reach out to me at roderick.johnson@sba.gov. Next slide. This should be the last slide. Well, you have my number there. It has my email address there. So feel free to reach out to me. And of course, you have the main number there too at 202-205-8000. This should be the last slide. Next slide, please. All right, there you go. So now we'll open it up for questions.
Yeah. So thank you, Rod. That was very helpful. A lot of good detail on that. I would bet one of the questions might be from people, I don't see it yet, but can I get a copy of the slides?
Yes.
Okay. All right. Yes. So we can provide those to anybody who had that interest. All right. Let's see. I did see. Oh, and by the way, folks, I did also put in the chat a link to the Loudoun SBDC and where you can go to apply to get advising if you're kind of confused. And so so there's lots of resources. There's no wrong choice. You can go directly to SBA. You can ask Rod. You can go through the website there. You can talk to a local advisor. You know, if you have a bank already, they may be able to answer some of the questions. So there's plenty of help out there. Don't feel like, oh, I'm overwhelmed. I don't know what half of you was talking about. Just if you know you need money and you think one of these products might help you, then you need to reach out and get somebody to help answer some additional questions for you for your own individual situation. Wouldn't you agree, Rod?
Yes. Yes.
Yeah.
Absolutely.
Yeah.
Yes.
Good. All right. So we do have a question. The question is, are veteran-owned small business loans, are they SBA and 504? Are they different loans?
Oh, okay. Well, actually, the Veteran Express loan is really not any different than the SBA 7A Express loan. Okay. Yeah. But it happens to fall under the family, within the family of the 7A loan. All right, that's all. Yeah, so you can get a, if you're a veteran, you can go, really, to be frank with you, you can get a 7A SBA Express loan versus the veteran loan. All it is that if you get the veteran loan, the bank is able to say, if the SBA comes to them and they say, well, how many loans did you make to veterans, women, on and on? Okay, so it just makes it easier for demographic purposes. But the 7A Express and the veteran loans are exactly identical in terms of terms and interest rate. Yeah.
Got it. Okay. All right. That's good to know. That's good to know. All right. Do we have any other questions? Wow. I think you did a great job.
Well,
Man.
Here's the thing. Again, as the borrower, you don't have to pay any SBA fees, and the bank doesn't have to pay any SBA fees. And if you go for the 7A, and I'll use the real estate again, so on a $2 million real estate deal, the bank is actually getting a 90% guarantee, okay? And normally on a $2 million, real estate deal, you're paying as the borrower, you would pay a 3.5% SBA guarantee fee. You don't have to pay that now at all. Yeah. Okay. So as the borrower, you pay no fees, and the bank gets a 90% guarantee. It's like, why wouldn't you go ahead and do the deal now? Mm-hmm.
So I'll ask kind of a question that relates to some of the members we have at our business incubator, the government contractors who are HUBZone certified or getting HUBZone certified. So if they should buy a building in a HUBZone, there's even some additional advantages as a HUBZone company as well, correct?
Yes, there is.
So if they get to maintain their HUBZone certification regardless of the zone, right?
Yes. Yes.
Yeah. It's a 10-year, I believe. If you buy a building in a HUBZone, for the purposes of continuing your HUBZone government contracting, you will be able to maintain that certification for a period of 10 years, whether or not the zone you're in is uncertified or not. So, So, and then combined with what you're talking about, the great, rates and the great terms that there are now, it seems like a no-brainer. I do know that we have a company in Leesburg who is a HUBZone company. And they bought a building recently and have taken advantage of the SBA loan products. So,
yes, actually, I think I'm trying to remember the name of the company.
The Building People.
Yes, that's it. Because I was a part of that.
Yep.
Yes.
Yep. Yes. Yeah. So they're a great example. They went through our business incubator. They really have taken advantage of resources. through the
They
SBA.
have.
So yeah, so they're a great example of a company that took advantage of the Hub Zone program. They got started.
Yes.
They grew their government contracting business. They went to one location. They're in another location now and decided to buy the building, take advantage of that program, the loan and the Hub Zone, certification. So yeah, it's a good
Yes,
story.
that was a good story. Actually, I'm looking forward to the physical grand opening, right?
Yes.
Because yeah,
Exactly.
when we get back to normal, I guess.
Right. But for those of you in Loudoun County, I mean, there are plenty of Loudoun businesses that are taking advantage of these programs. So certainly you want to look into it for whatever your needs might be.
And you have good lenders out there. You have Main Street Bank, you have PNC, you have John Marshall. Okay, you have a lot of good Fauquier Bank, but yeah, I think it's Bank of Fauquier, but yeah. So you have all these great banks that are out there, okay, ready to lend to you guys.
Right. Well, and good, they're good, solid community banks, which I think we found, through the pandemic process and through even the PPP and EIDL loans, that having a good community bank that you're affiliated with can really make a big difference. I don't know, I have heard that many of our clients, small businesses who didn't really have a good relationship with their bank, they really struggled in the initial phases of getting some of those programs, because the bank was sort of like, who are you? We don't know you. We're a big bank. You're on the bottom of our list. So really, I think if you've learned anything through this, learn that you need to have a relationship with your community bank, no matter when you might need it. You've got that. That's
right. I think, and actually, Susan, I think you guys in one of your programs that you have there, you talk about the importance of having a banking relationship.
Yes. I think it's our start your business class. We start early. You need to start early with that relationship, because you might not need something right now, but you want to establish yourself with somebody who's friendly to you, who knows your business, who's ready to kind of step in.
Yes. All right, I'm seeing something about terminology.
That's what I just put a comment in there. If the terminology seems overwhelming, reach out and get an appointment with one of your SBDC advisors.
The bank seems to move the lender to take a loan instead of SBA if the lender has good credit.
I didn't. Hold on.
All right. So
okay, good.
Here's typically what happens since I've sat in that chair. So a deal comes in, and the lender can decide whether or not, well, what they should do is talk it over with you, the borrower. So they should give you, for example, let's use a real estate deal as an example. So they should give you a term sheet for their conventional financing. They should give you a term sheet for the 7A loan, and then they should give you a term sheet for the 504 loan. And then let you determine as the borrower which one you think is better for you, okay? So for example, you may not like the fact that you had to make 2 loan payments to the Community Development Corporation and to the bank for the 504, okay? You may like it that you just make 1 loan payment to the bank, which is the 7A, okay? Because the 504 and 7A only require a 10% down payment. You may totally disregard the bank's conventional financing because you have to put down 20%, 20 to 25% going into the deal. Whereas with the 504 to 7A, you put down 10%, and the additional 10 to 15% that you save, you can use that money now to do renovations in the building or do leasehold improvements, okay? So that bank should give you 3 term sheets when you go in there with your deal: conventional, 504, or 7A.
We have one last question, and then we're going to wrap up, about where can folks find a list of preferred lenders.
Oh, okay, yeah. You just go to the SBA.gov, and then it looks like a glass. You just type in preferred lenders, and a whole list of preferred lenders will come up.
Perfect.
Okay.
Good.
Yeah.
All right.
Yeah.
So SBA.gov and put a search for preferred lenders.
Or you can just email me if, you know, the SBA website seems to be too daunting. Just email me and I can give you the list off the off the top of my head with the contact. Okay.
Very good. Rod, you are such a great resource. We really appreciate your presentation. It's been just a wealth of information, and you're always so ready to help businesses. So
Yes.
we're lucky to have you on our team, working to help, businesses kind of survive and thrive. So thank you again for the presentation today. We really appreciate it, and we look forward to working with you again in the future.
All right. Thank you, Susan. And you
Thanks,
guys have
everyone.
a great rest of the day.
Yes. Have a good rest of the day. Have a good rest of the conference, folks.
All right.